During COVID, many carriers have had restrictions on their COVID underwriting. Due to COVID, they've had to restrict the types of cases that they do. If you've had severe impairments that were generally over a Table 4 rating, many carriers could not make an offer until after the ease of COVID. Other carriers have older ages where they couldn't make offers because of the risk of COVID. We now are just seeing some of those restrictions get lifted. So we're having more and more carriers daily lift those restrictions, so it's getting a little easier. For the last year, there's been lots and lots of COVID restrictions. So a year ago, you may have been a decline, and today you could probably get a policy if you were one of those individuals that applied and got postponed. So we try to make sure that any of those cases that we have at our agency, we go back and recontact those producers to revisit those cases, because now we definitely would have a home for them. We're also finding more and more carriers as they've navigated through the waters of COVID and lessened client contact and made things digital. We've also found that they've tried to improve and streamline their underwriting process. So we have a lot of carriers that have come out with accelerated underwriting programs that are pretty robust. We have one particular carrier just announced they have a concierge underwriting program, which is John Hancock. If you have a high net worth client, they have a brand new concierge program that will allow your client up to age 70 not to have to do some of the medical requirements that were once required. And they have a very generous limit on that service. It'll go up to $65 million of coverage. So that's a lot of insurance. We have many programs that carriers are coming out with to streamline that process for the consumer. So we are constantly sharing those as they get announced by the different carriers, but we really expect by year end to have even more carriers that have made it easier for an insurance client to be able to apply for a policy and get through the process.
Very good. Thank you for sharing. Chris, you want to add to that?
On the DI side, I'll touch on that since Angela's covered more on the life. A lot of the carriers on resident programs, they've gone to 7,500 without it, financial underwriting.
Do you want to break that down a little bit?
So basically, if you're a resident, last year resident, and you're graduating and you've got a contract or you don't even have a contract yet, they'll issue you up to $7,500 a month coverage without even having a job yet.
Very nice.
With FIO, future insurability options, where you can double your coverage over the life of your contract. So, you're looking at nearly $15,000 a month of coverage with no underwriting, real underwriting. So it's pretty exciting. Back in the late 80s, early 90s, it was the app prevention department. You couldn't get a DI case through because there was just so many claims tripled in 1 year due to the healthcare reform back then when Hillary and Bill were in office, and that was a threat of that. So times have come full circle, and this is a great time to be writing some income protection.
We also have a few carriers that will do small groups, executive carve-outs for guaranteed issue for disability. We're working with a producer right now on a case of 5 executives, and we're doing a guaranteed issue disability offer for those executives, which is really good because in the disability space, you normally have to have 10 or 15 individuals to get true guaranteed issues. So we have some specialty markets that we can offer for that.
And then our clients, as they get older, like us, and I'm 52 now, and you start to think about, having more long-term care coverage than income protection or, cover down the future. So, a lot of the carriers have stepped out of that field. I think we've got 3 that only specialize in that today. Isn't that about 3 carriers?
3 to 5.
3 to 5. And then everybody else has come out with hybrids. So life with LTC, and you're going to use it either way. So if you don't die, well, if you need the long-term care, or if you pass away, you're going to get paid either way. So.
Right. And most carriers now on their permanent plans of insurance have chronic illness riders, accelerated death benefit riders. Some have long-term care riders. It would probably be a good idea, even if a person's not looking for long-term care insurance, if you're a younger age and you're buying a permanent life insurance policy, to show that rider because at the younger ages, for probably less than 5% of the premium, you could add that rider and they'll have it for the rest of their life. And then when it gets time to start doing long-term care planning, they've already got a solution in place. They could always supplement and get more at that time if they wanted to, but it really is a good thing because they're getting a bargain because they're buying it when they're younger, as well as they're protecting their insurability in the event that when they get to start doing long-term care planning when they're 55 and up, if they have any health challenges, they've already got something in place and they don't have to worry about being exposed to that risk.